Greetings, Jonathan Camarda, Chief Investment Officer, coming to you just about midweek as the market shows some resiliency off of some support levels on the 2-year weekly charts, especially the S&P and Dow, NASDAQ, as well as they're all kind of swimming right in what they call the 200-day moving average area. 3 caveats, though, as you hear the battle of the bulls and bears and the talking heads that generally don't know what they're talking about on TV. Essentially, what's happening is that you have the dollar, interest rates, and a downtrend that needs to be broken that are controlling the direction of the market. Sounds real simple, as easy as 1, 2, 3, or ABC, or whatever that song was from 40 years ago or so, for you nostalgia fans. The strong dollar, obviously, a lot of you have been taking advantage of in specific strategies, and we'll get to that on a macro level in a second. And then interest rates, obviously, catalyzed by the very, very jubilant Fed, jubilant being a great adjective for their enthusiasm for rising rates here. Are they really fighting inflation? We'll get to that in a second. And then also the last point is the downward trend. Again, the downward trend is still in place and must be broken for equities to have any substance to the upside these nice days aside. Now, you'll see in some of your strategies that we will start to take positions. If you're wondering why, that's wise because, again, you could never necessarily see a bottom ahead of time. It's only in your rearview mirror. So as my father used to say, you have to look fastball and adjust to the changeup. Otherwise, you're smelling leather. And so unless you're in a Haverty's store, that's generally not a good thing on a baseball diamond for other frustrated baseball wannabes like me out there. So off of that diatribe, the psychologist is well paid, don't worry. So off of that diatribe, those are the 3 areas that we're looking at. So a lot of you, like I said, have been taking advantage of the strong dollar, rising rates and weak treasuries, right? We've been short treasuries and some of the strategies. But those spells must be broken, folks. And again, we're still looking at 75 basis points here in early November, as we've been calling a couple of months. If you look at the CPI data, it's still pretty hot. Now, that is a lagging data point. And things like rent and such are lagging indicators that do get stuck in the system there that could cause elevated CPI numbers. But the Fed seems to, whatever reason possible, to elevate rates on the front end. As James Bullard, you guys know, one of the hawkish members, has always said, you got to front end it as far as the rate increases, right? Like putting all the weights on one end of the barbell, and then in the back, we'll just let it ride. So we're waiting for that let it ride point as the U.S. economy, and really the global economy for that matter, is taking this, this injection. We really don't know the results yet as it works its way through the systems. Most economists look at that at being 6 to 9 months for each rate hike. So, a lot of digesting there to happen. So with that being said, those are the core areas that we're looking at. Now, from a macro level, you have to wonder, and again, we read a lot of information from institutional software packages and managers out there smarter than us. And there is some thoughts, though, that since energy and food, right, are the heaviest parts of the weight that the U.S. citizen carries, especially medium and lower income folks, that is not controlled at all by the rate increases. So when the Fed marches with their flags held up high that they must fight inflation, you have to wonder if that truly is the mandate. Now, you may recall, again, there's no facts no smoking gun that you can look at that necessarily has any certitude here, but the mosaic area, if you will, is the macro picture, which is what we try to do for you folks. Give you what you're not seeing on the news, reading in a paper, but with some of the smart money, the money that knows what, when, where, why, when we're still scratching our head going, huh? That's what we're trying to give you some introspective thoughts here. There is a thought, as you recall, if you go back, a few months ago, talk of some of the countries that, let's just say, are not necessarily our best friends, of talking about denominating oil and energy in currencies other than the dollar. Do you remember that? Well, go back, Google it, you can look it up. When you're not having the pleasure of being put through this maniacal analytic misery. But when you look back, you'll see that. You don't hear that anymore. Why? Because the Fed and the U.S. dollar has taken the lunch money, no pun intended, from all the global currencies. I mean, you look at the Bank of Japan. Of course, China's economy is a mess. You look at the Bank of England. My gosh, and that new regime coming in, what a mess there. But the global currencies are quite feeble relative to the greenback, and you don't hear a peep anymore about denominating, at least in no legitimate press, and denominating energy in any other currency but the dollar. So there are some folks that perhaps, like the Greek gods of the monetary systems, that seem to think that there may be a larger macro battle happening, and the markets are just that battlefield, a football field where the blood is being spilled, essentially saying that, again, this is about global macro control. And then, of course, inflation is the villain, if you will, on all the TV screens and the want ads, but not necessarily what the mandate is. Now, that could be just conjecture, but it seems to make sense when you start to piece it together, when you say, well, everything they're doing, is it really working? Look at the CPI numbers. And energy and food are not controlled by rates. The elusive obvious. All right, so with that being said, a little bit of introspective there. That doesn't really help us. We just got to know what's going on. All right, we can't live in the metaverse. All right, no offense, Zuckerberg. All right, take the glasses off. This is reality. So we keep that shield and sword up, protecting your hard-earned money as best we can with all the tools and resources that we have. And we never forget that you work so very hard to earn it. And we're just privileged to be serving you, all levity aside. So with that being said, I'll end there. Appreciate your time, patience, and most importantly, your trust. Until next time, stay frosty.